Hello everyone, this is Paul from the Pin Academy, and in this video we're going to be looking at how you can actually correctly set a stop loss. Now this is one of the most requested videos from you guys, and we have brought it to you guys. So I hope you guys are going to sit tight until the end and you understand it. Actually, this is a very big problem to even pro traders, even traders who have been trading for some time. That's why you'll find most people choose not to trade without stop loss, which becomes very dangerous, right? You find someone has struggled to raise an account and actually along the way loses it. That's why they say there are very few traders who can actually keep an account for 90 days. You can just ask yourself, you who is watching this video, have you ever kept an account? Have you ever deposited and kept that money that you deposited? Instead of losing it, you keep increasing it or growing on it. Or even if you're just break evening for 90 days, those are just 3 months. Have you ever done that? You can just comment in the comment section below. Just let me know. I'll be looking through the comments. Just let me know in the comment section. I'll be looking through. I want to see how many of you have kept an account for 90 days. Now, if you have not kept an account for 90 days, this is probably one of the major reasons, because you'll hear everywhere, trade with a stop loss, trade with a stop loss, right? Which is true, though other people opt to trade without it. Depends on how you handle it, right? You may choose to trade without it, but when you know that this is a point of my invalidation, or this is an area that I'm going to get out of this trade if it went bad. Now, for those who do not know what a stop loss is, let's first start by defining what a stop loss exactly is. Now, a stop loss, what is a stop loss? A stop loss is, for example, if you're expecting to buy, right? And then this is your entry point. Let me put it entry. And you expect the market to go up, and this is your target, let's say. You expect the trade to move up to this point here, right? Now, this is what most people focus on, the profit part, in case it's going into their direction. Now, what about if that trade goes against you? Because we all know, by now we should all be knowing that trading is about probabilities. It's not a sure, it's not gambling. People think trading is gambling. If it was gambling, you wouldn't be studying. You'd be stressing yourself watching even this particular video. You don't be looking for all this knowledge, right? But most of the things that we go through in life are probabilities, including trading itself. So it being probability, you also need to have that what we call a risk, right? You have to know that I'm risking this. Whether it has met all the rules that you normally look out for, even if you have experience, you've been trading, let's say, for 20 years, 10 years, 5 years, and there are some patterns that you've been seeing always happening out. Always you must have an invalidation point. An invalidation point is where you're going to place your stop loss. Now, as the title suggests, how do we properly set a stop loss, right? But before we get there, let's first identify what is exactly the stop loss here. Now, the stop loss is that point at which you say that, no, I can't take this. When it crosses this point here, I am out. I'm okay with this loss that I have made, because it will be going against you. Now, this distance here is what is giving you the stop loss. The stop loss area is that price at which your security price should not cross, right? If it reaches there, automatically the broker should exit you from the market. That's what we call a stop loss. It's an automatic order at which, if the price reached, the broker should automatically close you out with that particular loss that you're running in at that particular time. Are we together? While the target, or what people call take profit, is the broker will take you out at that particular price. Even if it continues going up, you're like, no, me, I'm okay with this price or with these profits. Once the price reaches this price, automatically kick me out of the market with my profits. While stop loss is vice versa. I hope now you understand what a stop loss is, right? Now, having understood that, now I would like us to clearly go into the aspects of the video that I want you guys to understand. Now, before you even start thinking about setting a stop loss, there are certain things that you need to put in your mind, and they're as follows. One, you need to know, or you need to be comfortable with how much are you okay to lose? How much are you willing to lose? Most traders not put this in their mind. This is one of the most psychological aspects that we tend to ignore, but actually it can change your trading, can change your whole trading career, in case you're taking it as serious as I do, as serious as my team members do, or as serious as some of the traders do, right? If you're really serious about trading, before you take any trade, before you set any stop loss, you need to understand, how much am I comfortable to lose in this trade, that even if I lost, I will still have capital to take the next trade. What is making you guys lose is you're going all in, which is not bad sometimes, because in risk management, we're going to have a video about risk management, whereby you can sometimes split your capital into partitions, then you can risk that partition, which is okay. But if you're putting your capital in one place, you need to be deciding, what am I comfortable with to lose? That is one. Then two, you have to put into consideration structure. When you're thinking about stop loss, you need to put into consideration structure. What are we talking? What do we mean by structure? By structure, we do mean the shapes being formed, the patterns being formed, right? All those structures, the turning points that the market is creating, whether it's moving down, whether it's moving up, right? That's the market structure that we're talking about. It has to be one of the things that you're looking at or you're thinking about, as long as you want to talk about stop loss or you want to set your stop loss. Are we together? The third thing you have to be considering very, very highly is what we call confluences. When it comes to stop loss setting, when it comes to take profit, confluence is not important. But when it comes to stop loss, your confluence is very, very key, like we're going to see in the video, right? This confluence is important in two ways. One, when you're setting your stop loss, and two, when you're taking your entry. This is when it is very, very important. So just a little recap, you need to know, or you need to come to peace with what you're willing to lose. Once you do that, you will have a proper psychology ready to be into the market. And secondly, you need to consider the structure. The number three aspect that you need to consider is confluences, which we have just spoken about, right? So these are the three things that you need to have in your mind before you start thinking about why am I going to put my stop loss? How am I setting it? At what point is it going to be, right? These are the things you need to have in your head. Now let's dive into the video a bit deeper, right? So, what are the things you're not supposed to do when you're setting a stop loss? Let's go through them one by one, right? The first thing is, we traders have a tendency of putting our stop losses at we have a rigid mind that every trade I want to take, we don't care about the security. We're just thinking of maybe you have to put your stop loss 5 pips away, right? This is what you guys have. My stop loss is always going to be 5 pips away, right? Today you put 5 pips on this setup. Then again, also, this is your stop loss area. Let's say you're buying, or let's say you're selling. The market, you expect the market go down, and you put your stop loss 5 pips. Like most of you are doing this for every trade, which is very, very dangerous. Why is it dangerous? Because securities have different pip values. We have different pip weights. Are we together? And also, the structures we are trading are different. The distances that those structures give us to cover are very different. Why? Because we're going to look at some of the aspects, like you people are setting stop loss in different time frames and also setting targets in different time frames. Are we together? So you should not be rigid. You guys are putting your stop losses, the risk that you're willing to take at specific pips. Now, there are very many different securities. For example, if you trade forex is a bit light. When you trade commodities are heavy. So if you say 15 pips, the 15 pips of gold can be taken out in maybe a 1 minute candle and all that, meaning you're going to lose out on a good trade. Then it moves after in your direction because you're sticking to a rigid mindset of putting a bad stop loss. Are we together? That is the first thing that you have to first deal away with. Do not put your stop loss at rigid places, like the same place. Like whenever I'm taking a trade, I have to use 15 pips. Whenever I'm doing this, I have to use 20 pips. Do not cram that, because we're trading different securities. Even if you're trading forex, the structures that are being given by the market at that particular time that you're going to use to take the trade is going to give you different targets to be covered. I will give you an example. For example, you may be trading an impulse on the retracement. If you're trading this retracement here, the target distance, this target distance is different from someone who's going to trade this continuation up. Because after an impulse, we know we have a correction and an impulse. So this distance here is not the same as this person who's going to trade here. Meaning even the stop loss requirements are slightly different. So do not be rigid, right? And also the rules of taking trades are a bit different. If you're using a trend line to enter a trade, it's going to be different from if you're using levels, right? Because sometimes some people take trades using candlestick patterns, some people take trades using turning points, some people take trades using areas. So all these aspects are different, they vary, right? So it's not good to cram that I won't be taking trades on this, right? Now, the second aspect that you have to not do when you're setting stop losses is having a bigger stop than the profit target. This is what most of you guys do, and I'll show you here practically. Look at this, guys. Look at this. This is red area here is your stop loss area, and this green one is your take profit. You will never make money with this type of mindset, right? Let's just take an example at a business. Let's say you buy a car, you're a car reseller, you buy a car at, let's say 200K USD, and you resell it at 90K. You've not driven it maybe for years or what, you're just a reseller. This is not business. This is actually what you're trying to do in the market. Guys, trading is just like any other business. You cannot tell me you're going to be risking. What this means is, let me just show you what this means. What this means here, this situation means that you're risking $100 to make, let's say, $10. This is not acceptable. This is not business, guys. Are we together? This is not business. This is what most of you guys are doing. So make sure you avoid having a bigger stop loss than all that. But what is going to cause that? Make sure you stick until the end so that you follow through. Well, I'm going to give you steps towards the end, how you're going to set your stop loss properly and you'll not have any problem with what you've been facing, right? That is that's another big aspect. Are we together? Now, let me also show you another, what normally happens sometimes also, right? Changing stop loss because the price keeps going against you. Are we together? Now, this one, tell me if you're a victim in the comment section. I know at least most of the traders I've interacted with have been facing this issue, right? Now, let's just explain this a little bit in detail. Let's say you have a W and the market came and retested with a weekly retest properly, but because of certain factors, right? Maybe you entered the trade from here. This was your entry, right? You took the trade from here, and let's say you're targeting this area here. So you put your stop loss here, and you have maybe a 1 to 7. Now, what traders do, this is your stop loss, this is your take profit. What traders do is they will keep extending this stop loss as the trade goes against them. This is how you end up blowing your account. Remember with what we started with, you have to first be at peace. You have to decide with yourself that, what am I willing to lose? Am I comfortable with this? Won't it hurt my account after this trade? Because that trade is not the last trade you're taking. Remember, you're in this business for a long period of time, right? Hope you've not forgotten the question I asked you. Ever since you deposited, have you ever kept an account for 3 months, for 90 days? In case you've not, please first leave live account trading, go back to the demo account and backtest. I won't leave links of accounts you can register with. Get demo accounts, and do not pick big demo accounts. Pick small demo accounts, especially IC markets. We have IC markets that gives small demo accounts. I'll be speaking about some of these reasons why we say that some brokers give you good demos, and most of the demo accounts you guys are getting are bad demo accounts for you in your trading journey. Some of you are planning to start trading your live accounts with $20, but you're getting a demo account of $1 million. You don't have that money. Why are you practicing on $1 million account? Get that account, blow it down to the amount of money you're willing to deposit when you go to live. But you're practicing with money that you've never seen in your life, you will never have, and you're practicing with it, which is very wrong. And the brokers have played on our psychology. These liquidity providers have played on our psychology like that. Deposit money or practice with money that you have, that you can put in the market, that you're willing to part with when you're going to start live trading. Are we together? So this is one of the aspects that does make people lose money. You keep extending your stop loss. You put your stop loss here because the trader has gone against you. You shift it. You shift it. By the time you realize you're coming back to this situation, you have a bigger stop loss than your take profit. Are we together? Let's avoid that, right? So this is a situation that has happened to most of the people I know, and you can clearly see. Let me explain it here with a diagram. This is how the person will start, right? This is your first take profit. Then what will happen? The next thing that happens before you know it is this: the person has extended the stop loss. Are you seeing? This is how you started. Your risk was small, but by the time it's going, you've doubled. Let's say you've said that I'm losing 5%, I'm willing to lose 5% of my account. And then from there, you've almost doubled. You're losing now 10% of your account, meaning you're already reducing the possibilities of you taking more trades in future. This is already reducing the number of days on your accounts. For you to be a good trader, you must be able to protect money. Actually, I normally tell people that I have engaged with, that I've taught privately, that the most important thing is not the money you're making. The most important thing is protecting what you've made and your original capital. That's the most important thing, right? Yes, you're going to risk, but when you make, are you able to keep that money? The same happens or implies for all businesses. If I've made profits, whether I'm dealing with real estate, whether I'm dealing with agriculture, if I make money, am I able to keep it, then reinvest it properly? Are we together? This is how trading should be. But most of you are taking it like something that is very, very different, which is not proper, right? So this is what most of you guys are going through, right? So what are the do's that you're supposed to look at critically when setting a stop loss? The first one is you should be flexible, not rigid. We've spoken about this one. And your stop loss should be based on structure and confluences. For example, most of you are just taking stop loss because of being rigged. That my stop loss has to be at point X, 15 pips away. This is don't do that. So we're saying that your stop loss should be based on structure and confluence. By confluence, we've already spoken about confluence trading in one of our previous videos. I'm just going to attach it in the top right corner. Make sure you look at it. Confluence trading. What I mean by confluence is like bringing more than one aspect. We have two types of confluences: time frame confluence, and also we have what we call analysis tool confluences. So make sure you watch that video in case you don't understand what I mean by confluences. So in brief, I mean that let's say if I have a W and this is a support area, and at the same time, this is my support, let's say. I'm planning to take my trade when the price comes here. And also I have a moving average, those who use moving averages. If the price comes and retraces here, this area here is providing me a lot of confluence. Why? Because this moving average is acting as support. And also this neckline here is acting as a support. And let's say we have this weak retracement here. This is also acting as a confirmation for me that there are big chances of this trade going upwards. This is what we mean by confluence. So if I'm going to put my stop loss, I have to make sure I'm putting my stop loss below this neckline, and I'm also putting my stop loss below this moving average, so that if the market reacts, let me just draw this properly. Let's say if this is my W, this one here, and I have a moving average coming down here like this. So the market has already retraced here and has touched this point here, but has already touched the moving average. So if I'm going to consider moving average, my stop loss, I have to make sure that it is slightly below all the confluence factors. Maybe I also have a fib, maybe it's an impulsive move. I have my fib levels here. I have to make sure that it's below the fib levels that I do consider. I'm also going to attach the Fibonacci retracement video. Make sure you watch it. Then also it's below the moving average and below this neckline, so that all these confluences are acting as your protection, right? Let me give you an example in real life. If let's say you're going somewhere and maybe you're a high profile person, or let me just give an example of high profile people. You've seen how presidents are protected, right? They have escorts, the cars that are escorting the lead, or they're called lead cars, right? So the people or their soldiers or their bodyguards that are following the main car where the high profile person is sitting. Are we together? So also you need that type of protection. You need more than one, because if you just have one, the price can easily go through it. Remember, price is not it's not a move in a perfect movement. So we're always going to have things like slippages in the market. We're going to be having spreads widening at certain points of the day. So you may find yourself being caught off guard if you don't consider these things. Then also you should put into consideration that the stop loss should vary. I've already explained it should vary with different instruments. For example, those who are trading synthetics, I'm going to attach, in case you don't know what synthetics are, we trade them 24/7. I'm going to attach the link below. Make sure you get a demo account. Practice. Do not go live without knowing what you're doing. So synthetics, you can trade them 24/7, or even on weekends, you can trade them. But now, the example that to give is this. Synthetics do vary. For example, if you're trading volatility 75, right? Its pip value is different from when you're trading Euro, USD. So your stop loss of one that you use that you're going to be using to trade on V75 is not the same you're going to be using on Euro USD. One, they have different pip values. Two, the momentums are different. The structure that you may want to trade with on here is different from maybe the structure you're trading here, maybe an impulse. So all these things, you have to consider them. So you have to be flexible, and then your stop loss has to be based on structure and confluences. Then also you should be varying. Your stop loss should be varying with different instruments and also the structure that you have seen. Do not just cram that my stop loss is supposed to be 5 pips away. Some of you are being taught and are telling you stop loss should be these pips away. Stop loss, those things change depending on the structure that you've seen and you're considering to use in your trading, right? Now, the best example is here. let's say we have this head and shoulder. This is a shoulder, this is a head, this is a shoulder, and this is a neckline. I want you guys to just see this. The neckline here has been taken out, right? My entry was here after we look out this area on the retest of this area, because I'm using this second shoulder to take my trade. I have something like a big M also here. So on the break of the neckline on the retest, that's where my entry is. So it's the shoulder. So my stop loss is this neckline. They have this neckline, and also I have this triple top or double top, depending on how you're looking at it. This one here, I don't know if it's a triple top. We have this top here, we have this top, and we have this one. Okay, multiple tops. This is a very strong area. My stop loss is just above this structure, meaning that I have this standing point here, this standing point, and this standing point protecting me. And by the time the market breaks below this neckline here, meaning now I have this neckline, I have this neckline, and I have this standing point. A lot of confluence is protecting me. I have this M, and I have also this big head and shoulder neckline, right? So in case also this trade had a moving average, like let's say coming down this MA, I would still put it above, right? Depending on the confluence you want to use, there's moving average, there's MACD, there's Bollinger Bands. Though we don't trade using those here, the farthest we go is RSI and moving average. Though you have to combine them with technical analysis. Technical analysis is the most important thing, price action, right? So this is what I've been explaining exactly, right? So make sure you do these things or you follow these steps if you want to set your stop loss correctly to avoid putting a stop loss, you're kicked out, and then the market later goes into your direction. So what are the steps that we are going to consider when setting a stop loss? One, determine your risk exposure. Two, always use entry time frame to set your stop loss. Some of you are setting stop loss in the time frame you're using to do analysis. We do not set stop loss in the time frame for analysis. Are we together? If you do analysis in daily, you can't set your stop loss in daily. Your stop loss has to be in H1, where you take your entry from. I'll show you this one practically on the chart. This is a risk-to-reward ratio. Just look at this example on the image here. This is a risk-to-reward ratio of a stop loss that you're going to use in daily. It's going to be wide. You're only going to be making 1 to 3. That's if you have capital. It will need a lot of capital to hold it. Now, I need to look at the risk-to-reward ratio of the one that has been taken in H1. Just look at this difference here. This person of H1 is having a risk-to-reward ratio. This one here is having a risk-to-reward ratio of 1 to 6.6. Why? It's the same setup. This is the same setup, right? But this person is setting the stop loss in daily, meaning is risking more, right? You're risking twice this person here who has taken the trade in H1, right? So make sure you also put that into the factors you consider when setting stop loss. First, determine your risk exposure. By risk exposure, I've spoken about this already a couple of times. You need to determine that per this trade, or for this particular trade, I've seen this, I've seen this, I've seen this. This is my confluence, and it should be below this structure. I'm willing to lose this. Am I okay with it? That's your risk exposure. Then secondly, you should determine all these things in entry time frame. The stop loss should be set in entry time frame, not analysis time frame. Right? I can't stress that enough. Now, the other aspect that I would like you guys to also put into perspective is you should identify structure that you're using to take that trade. So your stop loss cannot be within the structure. It should be either slightly below or above, depending if you're taking a buy or sell. Your stop loss cannot be within the structure, because the market maker will come and kick you out. What do I mean by within the structure? For example, you guys want a sniper entries. For example, you have a W, right? And your stop loss is within here. The market can come and take you out, right? The best stop loss can be just slightly below structure, unless you have this is an impulse and the market has retested the fib levels and your stop loss is below those fib levels. That is okay. If the fib levels is here, and then you also have a moving average, then you're protected below there. And also you have maybe an order block somewhere. That's when maybe you can put your stop loss below. But if there's nothing in here, make sure your stop loss is below structure. At least find a structure. It can be a foreign body, it can be an order block, it can be a supply or demand level. Make sure those things are protecting you. Are we together? So so let's continue. Then lastly, make sure you attach a confluence into your trading always. Attach confluence. Confluence is going to save you a lot. Are we together? Right? So these are the steps that you're going to consider, so you can be able to set your suitable stop loss, right? If you follow these steps here, you're not going to put a stop loss, then you get kicked out of the market. Are we together? You're getting kicked out of the market because you're setting your stop loss either in a bad time frame. You don't know what you're planning to risk out of all your capital, and also you're setting it in a wrong time frame. You're not putting confluence. You're not using structure. You're just having a rigid mindset. But if you follow these steps here, you'll give me a feedback. So once again, my name is Paul from the Pin Academy. Hope this video made sense to you. If it did give you value, make sure you give us a thumbs up. That's it for today. Let's meet in the next video. Have a great day.